How's it going, everybody? And welcome back to the Real FI podcast. I'm your host, Patrick McGrath, with my lovely co host, James Rippion. How's it going today, James?
Lovely co-host. I feel like I'm getting a promotion today, man. I like it.
It's
I
2023.
There we go. New year, new me. Um, I'm excited today. We're going to get to talk about one of my favorite subjects because nobody likes to go through what we have to go through every year, and it's good to prepare. We're at the beginning of the year, 2023. It's all about taxes. We got our friend Natalie Kolodij here. She's an accountant. She's going to be able to give us some information about taxes, how everybody can maybe prepare themselves for the year ahead. Of course, as I always like to say, and every accountant likes to say, tax preparation is a forward-looking exercise. It's not a backward-looking in January, like how do I fix my 2022 stuff? So none of this is going to be talking about 2022. We're looking hopefully forward. So let's go ahead and get started. Natalie, why don't you introduce yourself and tell us and our listeners a little bit about yourself and what you do.
Yeah, absolutely. So I am an IRS enrolled agent and real estate tax strategist. I got into real estate and tax kind of at the same time out of college, so I ended up really specialized in it. This really cool thing happened where this happens at a lot of jobs, I think, where if you show you're good at something, now it's always your job to do that thing. So I just ended up with all of the real estate tax returns. 2017, I started my own firm, Kolodij Tax, so I could work only with real estate investors. And that's what I've been doing ever since. So I also invest. I do midterm rentals right now, but I've flipped mobile homes. I've had short-term rentals, so a little bit across the board, but I love the overlap of real estate and taxes.
That's so cool. I mean, and I love that you also invest in real estate. So, you've got the best of both worlds. You're not only heeding your own advice, but you've got real world experience to give to other investors doing the same thing. So that's a pretty unique circumstance. And everybody always says, if you're going to look for a tax professional, look for someone that invests in the business or is investing in the business that you're in. So I love that. Could you give us a brief rundown of kind of like um, your real estate investing portfolio, kind of, what you currently have, or how that even kind of started, what got you into real estate?
Yeah, I don't remember exactly how I started with real estate. I remember I was always one of those like serial entrepreneurs as a kid, like everything you could think of. Like at one point, I had like a set of finches that started having eggs, and I would hatch baby finches and sell them back to the pet store. And I was like 8. So I've just always had this mindset of like, oh, well, this is something I can sort of use to my advantage and figure out a model around. So I've always had this idea. And then I started in real estate in a way I absolutely discourage people from doing, which is I paid for one of the weekend guru courses, like the guy featured on TV, like so and so is going to come. Like, no, it wasn't him. It was obviously paid minions. And I left it more confused than I went to it. And that's how I stumbled into Bigger Pockets, which is where I sort of fell into everything. So I was on the forums just trying to kind of make sense of what I had just heard and what I was told and figure out what I could do next. And so, as people were helping me, I realized a lot of people had tax questions on there. And so, I would start answering tax questions related to real estate. And that's sort of how both things got launched at the same time. That course, what it sort of taught was if you're brand new at this, need to build capital wholesale, which a lot of people do early on. And, it works for a lot of people. I was really struggling with it. I was in the Seattle market, just a really high dollar market. So we were looking for other options pretty much on what we could do as like broke right out of college. Like it was literally the summer I graduated, uh, 20 somethings. And so my best friend and I decided to try flipping mobile and manufactured homes, which was something I think you don't see a lot of information on. But it was a great way to get started. I really enjoyed it. And for me, we were just talking about this before we started recording, like the idea of buying a low dollar version of something to see if you'll use it or like it first. This was that for me. Like, well, I only paid a few grand for this, so if I totally screw it up, it won't bankrupt me. That'll be fine. So it was a great way to build that confidence and not get like stuck on that initial analysis paralysis without worrying I was going to be stuck with a $400,000 asset at the end. And then from there, so I did mobiles for a while, and then I moved to Charlotte, and now I do buy and hold. And right now I have and am focusing on midterm rentals.
where are you focusing your acquisitions now? Is it in Charlotte, or are you kind of looking greater North Carolina?
Greater North Carolina. So right now I'm focused in Charlotte, but I'm looking at another town that's like about 3 hours away right now. Largely because, and what I'm basing it on is if you do midterm rentals, there's been kind of a unique shift the last 6 months or so. Because as lockdown wound down, the travel nursing industry is kind of almost reformatting. Like certain areas are having more demand than we've had previously. Some are getting really saturated. So I think Charlotte, a lot of the Florida locations are getting saturated because now those markets don't have the same premium pays as before. So before it was really appealing to go live in Florida, especially during the winter. And now they're not paying a premium. So these sort of higher priced midterm rentals in those markets aren't really meeting, like, the nurses' allocations can't cover those price points anymore. So I think these kind of weird secondary markets, if you join any of the midterm rental groups, where you can both post your rentals and see where nurses are looking for, you'll see real quick a pattern of someone requesting housing. And if there's like 40 listings landlord share versus someone requesting housing and no one has something there. So those no one places are where I'm trying to acquire 2-bedroom condos or small houses or things like that.
I love that strategy. If you wouldn't mind, where are you finding these little groups out there? Is it on Facebook, Instagram? Like,
Yeah, so Facebook is mostly where I'm finding them. So there's one that's literally backed by Furnished Finder, and that's one of the biggest ones, and that's the platform most people use for it. So I think it's just called like Midterm Travel Nurses Furnished Finder. But if you type in midterm or travel professional or any of those terms, you'll find a number of groups, but there's at least 20 that have just thousands and thousands of people in there. And what you want specifically is the one where you're allowed to post both directions. Some are only for posting jobs, and that sort of helps, but I like seeing the side by side of where there's a ton of houses being listed versus where there's a ton of requests for houses being listed.
yeah, I mean, I really like that. We've had a couple people on the podcast in the past that focus on midterm rental, specifically Yamu. If you haven't listened to her 2 episodes, go check that out, everyone that's listening. But that is I really like the midterm model out there, especially with nurses. But again, like you just said, specifically for the market, we thought about doing one in our market, but we're really close to Baltimore. And I know
Mm.
like that is like extremely saturated. So it's so hard to be able to make the numbers work, especially on like a 1 or 2 bedroom apartment. So I like your strategy on going to those like secondary, you know, markets where you could probably even do some sort of like arbitrage thing or something like that. So that's really cool. How many of these midterms do you have right now?
I just have a couple right now, so I'm just switching over to buy and hold after doing flips and then focusing on tax firm, and now I've just got a couple of the midterms.
Love it. Love it. So let's get down into the tax strategies a little bit for some of this. Like I know there's a lot of people that do Airbnbs,
Mhm.
the short-term rentals. So could you kind of give us the overview of like the difference with the short-term versus the long-term kind of rentals on your like high-level tax kind of strategy?
Yeah, and I'll tell you kind of the few key things that you need to know because a lot of accountants don't. Especially this time of year, this is the thing where I'm seeing like posts or responses from people over and over again online with the wrong information because if their accountant doesn't know real estate well, they miss this, and this is huge. So the biggest difference between kind of Airbnb, that's sort of in its own category, short-term rentals versus mid or long-term, those are in their own category, is passive income. So they're both passive in the sense of they shouldn't pay self-employment tax typically, but long-term rentals, sometimes you're limited on using your losses. So passive losses have these limits to them. So if you have long-term rentals that have losses, but your income's above $100,000, you might not be able to take that loss and reduce your income from your job. With a short-term rental, if your average guest stay is 7 days or less, and if you materially participate, there's 7 different ways you can do that. It's pretty easy to hit though, as long as you don't have someone spending more time on the property than you. So if it's fully managed, you might not. But if you're self-managing, should be easy. But if you have 7 days or less and you materially participate, falls into this gray area of being non-passive, which means that now any losses we generate on that property, you can use to reduce your W-2 income. So it's kind of a loophole. It's a great way to reduce your taxable income without being an IRS real estate professional, which is kind of the only other way you can use these big losses if your income's above that cutoff. On this, it's just based on property to property. So if you have a short-term rental, the things to kind of look for and be mindful of is if your accountant says you can't use losses because you make too much income, it means they don't know about this. This was sort of a pretty new thing because Airbnb was pretty new. So this didn't exist 10, 15 years ago. So if your accountant's been doing this since the 60s and hasn't taken a class since 20 years ago, they are not going to know what to do with this. So what that means is if they're telling you straight up, no, you can't use those losses, they're probably wrong. The other thing to be mindful of that we'll see is people putting their short-term rental on Schedule C of their tax return. So Schedule E is for rental income. Schedule C is for ordinary businesses. If you're a dog walker, you own a bakery, you flip houses, ordinary business. Putting something onto Schedule C triggers self-employment tax. It's an extra 15% tax. The only time your short-term rental should be on Schedule C is if two things happen. If your stay is under 7 days, and if you're providing what's called substantial services like a hotel. So if you're going in every day and cleaning it and making the bed, if you're offering meal service, if you're offering these above and beyond things like you would get in a hotel, then it would be there and you'd pay self-employment tax. But otherwise it shouldn't be. Even if it's non-passive to take the losses, it still shouldn't pay those taxes. And I see this a lot, and what it means is you're paying a ton of extra tax, an extra 15%, just because your accountant didn't really know where to put it. So be really careful of those two things, because like I said, short-term rentals can be this huge loophole, and so you don't want to either be paying extra tax or missing out on that big savings.
So when it comes to the situation where you're, trying to take advantage of exactly what you're describing, where are you seeing most rental owners accumulate the most losses that can easily be applied against W-2 income? Like, where can people kind of focus to kind of be able to pull that money out of the air and apply it in a tax efficient way?
Yeah, so typically when we're talking about losses on a rental, what I don't want you to do is go lose money. And I know that sounds sort of backwards, but we're not just wasting money to get a tax write-off, right? So rentals let you do something called depreciate them, which is basically the IRS's way of saying anything that's an asset, anything that's solid, that is tangible, should wear out over time. So you get to write it off over time. That doesn't really happen in real estate, but that's fine. Doesn't matter. This is just based on the tax law. So normally on a property, you get to write off the building value. It's actually 39 years. It's looked at as non-residential for short-term rentals. So if your property was $100,000, you get 1/39th of that each year to write off. But we can do something called a cost segregation. And what that's doing is actually a more accurate way to depreciate your property, because instead of saying, I just have this house, we're saying we have a house, but it's actually made of flooring and windows and appliances and all of these different components. A lot of those have a shorter life. So instead of 39 years, we get to now write some of that stuff over 5, 7, or 15 years, much bigger amount per year. Then on top of that, double bonus, we have something called bonus depreciation. And for the last several years, that's been 100%, meaning, and that applies to anything with a life of under 20 years. So any of those things that could be separated out in a cost segregation, you could write off that full amount year one. And that tended to be about 25% of your purchase of the building value. So on a $100,000 building value, that's a $25,000 write-off. So that's what we mean when we're saying losses. It's just a paper loss. So you didn't have to write a check during the year for $25,000 to get the corresponding write-off. We're just accelerating, we're pushing up more of that value to those early years, so you get that big write-off. To tack onto that, right now people are losing their minds because this was the last year for 100% bonus depreciation. There's people are like with pitchforks outside my office. But so for 2023, it drops to 80%, which is still pretty good. Like, that's a big write-off. But something people need to be aware of is being able to do a cost segregation and write off depreciation. The rules you follow are whatever the rules were in the year the rental went into service, not the year you do the cost segregation. So anyone out there, if you have a short-term rental that you put in service from 2018 to 2022, you can still do a cost seg and get 100% write-off. You can do one next year. You can do one 10 years from now. you'll have used up some of your depreciation by then. But the point is, if you've had a rental go in service between 2018 and 2022, it is still worth looking at a cost segregation because you can still qualify for that 100% depreciation write-off.
So I actually love that you said that because for my 2021 taxes, I did one for a property that I bought in 2020 and in 2021.
Mhm.
And I was worried about going forward, you know, but
Mhm.
I still have two other properties that I could do one on because I didn't even realize you could go back that far. So that's extremely interesting. I love that you put that out there, and I love how you also clarified it's about the building value. So for everyone out
Mhm.
there, it's subtracting the land from the purchase, and then you get the bonus depreciation based off of the building, correct?
Yep, absolutely. We can't depreciate land because it doesn't wear out really. The other things to be mindful of is there's an election you can make on your taxes to choose to not take bonus depreciation. And some tax professionals do this by default. I don't know why, but I just got a new client where we are stuck. We can't, she got two short-term rentals in 2020. Her tax professional made that election because it was made in that year. We can't take this large write-off. So if you made that election, just know you might have kind of shot yourself in the foot, and I'm super sorry. Um, but the other thing to be mindful of too with a cost seg is any new properties, at any point, you don't have to do a cost segregation the year you bought it. You can do them down the road. There's just an extra form on your tax return. Be strategic about it. If the year you bought it, yeah, that was all your money, like you bought that one rental and you thought you could quit your job and you made $12,000, you probably don't need a big write off that year. If 5 years later, like you launched a business during your year of unemployment in your mom's basement and now you're a millionaire, that's where you'll want the write off. So you can sort of time this based on when it'll best benefit you as well.
Mm.
I also love that because during that time you could become a real estate professional,
Mm-hmm.
have a spouse, and now all of a sudden your cost segregation from the property you bought a couple years ago is wiping out all of your income and traveling onto, your partner or spouse's income. So that's a really great strategy, man. We are knocking it out the park here in the first couple minutes with like actionable items that people can really, really take advantage of. Now, would you recommend someone using like the DIYcostseg.com kind of thing? I know I've used that in the past. It's a couple $100 for like anything 4 units or
Mm-hmm.
under, and kind of um got the point across. Like, would you recommend something like that service, or
So it depends. What I typically tell people, so it's allowed, right? And the IRS has kind of guidance, and it is like number 5 on the list. Like of the ways that are allowable, it's sort of their least favorite. Um, it is much, much cheaper. The trade-off is that generally they tend to be more conservative because they're not doing a full study really. So the trade-off in cost, you might be still losing that same amount of tax difference almost. So if it costs you $500 and a full study would have cost 3 grand, but because they were more conservative, it tends to get you about 5% less on average. So that difference might make up for the cost difference. So I I have clients who use it. If you have a really low priced property, like if we're just, if there's kind of a reason to do it, if we're right on the verge there, it might be worth it to DIY it, but just know you might actually be like spending more overall by leaving money on the table versus paying for a full study that could have gotten you an extra $10,000 write off, but you saved, 2 grand by doing the DIY one. So it's kind of look at them side by side. Most of the companies will give you kind of a ballpark before you move forward with them, and you can kind of see where that lands.
In your opinion, though, what size property should we be looking at before it no longer makes sense to actually do a cost segregation analysis, or does it always make sense? Like, should a property be valued at a certain amount before you kind of can rationalize
Yeah, here's two great examples I have. I had one client last year, hiring doctors, both of them, husband and wife, together, their W-2 income was like $900,000. They bought two short-term rentals in Tennessee that were each just under $1 million. So the cost segregation on those two let us write off $400,000 against like they got a refund. They got like a $240,000 refund. I was waiting for like the feds to show up at my door to like figure out how that happened, but it was all legit. The flip side to that was I had a client who had maybe 8 or 10 lower priced rentals. Like they were all right around $100,000, but they were at a point where they'd owned them for several years and they had bought them off market and they were cash flowing really well. So each year they tended to make and have profit of about 12 grand between these properties. So in that case, even though they were lower priced, I was like, well, we can look at doing a cost seg on 2 of these, basically stagger it out and do 2 every year. And we created this net of losses where even though her rentals are cash flowing really well at this point, she's not trying to sell them, she just wants to pay them down, where she wasn't going to pay tax on any rental income for the next decade because of sort of how we structured these sprinkling in of cost segs. So for me, there's not a cutoff where like, absolutely not if the property costs less than 200. The answer is it depends, but I'll also say talk to a tax person first. Because if you're not a real estate professional, if you don't have a short term, if your income's too high, you might spend the money to create a big loss you can't use. Like we want to be mindful of why we're doing it. The other thing is if you might become a real estate professional in the future, that doesn't free up any earlier losses. So if year 2, you do cost segs and create a $200,000 loss you can't deduct, and year 5, you're a real estate professional, like that sucks. And now those are stuck. You can't go backwards and access them. So just be mindful, talk to your tax professional and see. There's not a like cutoff for me in terms of property. But the other thing to think about too that I'll add is if your goal is lowering taxes, like some people are at a point where in their portfolio they're looking to kind of buy things for tax benefit as like one of their big drivers, different asset classes give you a better write-off per dollar. So like single family is pretty low. You tend to get 25% of the building value. A gas station is about 90% of the building value of the depreciable asset value. So what you spend 500,000 on and do a cost seg on can have a big difference in what you get to write off depending on the asset class too.
Wow. James, you're on mute while he tries to figure
Dang it.
this out real quick.
My
Go ahead,
dang
James.
dog, man. My dog was barking, got me all off cue here. We're gonna
Hey,
go.
this is real life. We're not professionals here. We're semi-professionals.
Dogs hate taxes.
Yeah,
I'm so sorry.
You got something to say. So as I was saying, if you could read lips, it was a great question, but I'll start over. So when you're looking at the gas station example versus a single family, what are some of the contributing factors that kind of make it way more profitable for a gas station to do this? Like what's the difference between the two asset classes when you're looking at the tax code?
Yeah, it's just what type of qualifying assets are part of them. So typically a commercial warehouse or a distribution center tends to have like built-in equipment and conveyors and systems like that that are all shorter life. So like that tends to be more than single family. Gas stations have this weird loophole in the code where basically a gas station, if it has a convenience store, I think it's under 1,600 square feet. It's just the way it was set up, and I'm sure this was some kind of political move incentive, and like I don't know why they pushed this through, but it's there, where basically you can write off the cost of the equipment, so the pumps, also the convenience store, the whole thing. So normally this is the only time where like the whole building qualifies for it, and also a car wash just as like a freebie. So if you buy a little gas station that has a small convenience store, a car wash, and pumps and spend 500 grand, you can write off on average 90% of that purchase. So it's just
Wow.
just kind of the tax code. And if you look at lists, like if you Google literally like cost segregation by asset class, you'll see kind of charts from a lot of companies, and they all vary a little bit, but that'll give you a good rundown of what percentage you can expect as a write-off of the type of property you're buying.
That's freaking awesome. That is very, very awesome. As we're going through this, I'd really like for you to break down to the listeners the difference between, their tax accountant and a tax strategist, what the differences are, why they're both important, and maybe, how to go about finding one. I know that's kind of a lot, but I think this is going to be extremely beneficial for everyone that's listening.
Yeah, it's kind of interesting. Because I think for years, like if you talk to your parents, they'll be like, I had a CPA who did my taxes for the last 35 years and we would spit in our hands and shake on it. And I didn't even sign a form. Like, and that was what you got. And now it's very different. So a tax, like a tax preparer, a CPA, an enrolled agent, um, that's a whole different thing than a tax strategist. So that's going to typically be someone you meet with once a year. They're going to take your forms, they're going to take the information you gave them, and they're going to put it on a tax return, and hopefully it'll be pretty much right. They are not going to sit there and say, oh, I think we can qualify this as a short-term rental with the loophole and add a cost seg. You're not getting any of that. If you're paying, $400 for them to file your 1040, you are getting $400 worth of value. And so like you'll see these posts online where people are like, what do you spend? And someone will brag like, I have 8 rentals and I only spend a straw penny. And you're like, oh, well, okay, I can guarantee you I would save you exponentially more than you're saving paying that person. So that's a tax preparer. They're literally it's compliance. They're filling out forms for you once a year thing. The flip side of that is a tax strategist. So like I focus heavily on the strategy side. I don't file any tax return. I don't also do advising and strategy on, because to me, there's not a value to it really. A tax strategist is someone you're going to work with proactively. They're going to look at your big picture situation. Like for me, I tend to look at people's next 3 to 5 years, because I want to make sure what we're doing this year isn't going to put you in a worse place for next year. Or like looking at your tax brackets. If you'll hear a lot of people say, I want to use cost segs to get to zero, but there's kind of a rate of diminishing returns, right? Your tax rate gets lower as your income rate gets lower. So we might want to spread some of the savings while you're in high tax brackets and drop it to a certain point. So a tax strategist is someone who's really going to be focused on big picture planning. They're going to suggest things to you on how to save money. They're going to look at how tax transactions are going to impact you, selling a property, refinancing it, doing a 1031, different asset classes, cost segregations. They're going to cover all of this with you. And kind of the way the industry is going, and people I think are starting to realize this, but those can often be 2 different people. So when someone says, well, I only pay $400 a year, but my accountant sucks, they never call me with advice or reach out to me. Well, this is why. Yeah, like these are very different services. It's like having the guy who changes your oil or having the person who replaces your engine. Like they're different skill sets. They're both important, but you shouldn't let the Jiffy Lube guy rebuild your motor. So they're very different. How to find one, it's a little tricky. So I typically tell people, ask them if they invest. That's kind of a given one. The problem is if you ask just any tax professional, like, do you work with real estate investors? Every single one will tell you yes, like all day long, they'll tell you yes. Doesn't mean they're good at it. It doesn't mean they really know what to do. They're probably just taking information, putting it on a form. I would say ask them about like the short-term rental loophole. Can I use my short-term rental losses? Do you know about cost segregations? How many 3115s do you file in a year? That's the form that ties to doing a cost segregation in a later year, changing depreciation. It's a little ahead of the game, but it should be out this year. But I'm actually working on a credential tied into the tax industry specific to real estate, so that there will be a way to kind of designate and find someone who has passed X hours of training and certification to show they are a real estate tax specialist.
That's really great. I mean, I I met my previous basically accountant, CPA at a real estate meetup, and they were part of running the meetup.
Mm-hmm.
And I used them for like 2 years. And then, I got into doing a 1031 exchange, started qualifying for the real estate professional status, was doing seller financing and all of this other stuff, kind of adding all together, refinancing, cash out refinancing, started doing a lot of creative stuff, and thought because, they owned a couple rental properties and, were an investor, and I met them from the real estate investor meetup, that they were going to be able to help me out along this journey. Well, I quickly realized that I outgrew them,
Yeah.
and he kind of knew it, so he tried to like set me up with somebody, but they weren't taking on any new clients at the time. And yeah, last year for our taxes, we weren't able to, we didn't file the 1031 exchange correctly.
Oof.
And we lost out on a lot. So I hired a tax strategist. And after I turned in my 2021 taxes, they were able to look at it and they found $13,000 that I'm going to get back from
Mhm.
last year return by doing an amendment. So they basically, they found enough money for me to pay them for almost the next 3 years, just like right off the get. So like I know you explained it really well, but I just want to put my own personal prefer like thing in there that like, hey, it's worth the money when you really start talking about, like you said, these long-term strategies, start doing stuff that's really creative and you're growing your
Mhm.
business. And this is a partnership, like you said, if you're going to like Liberty Tax or whatever, or H&R Block, like that's just a service. I think the tax strategist is more of like a long-term partnership to help both of you guys, grow your businesses. I mean, would you agree?
Yeah, absolutely. And I think the thing to kind of think about are that people, because I think they look at it all in one price bucket too. And this is happening with a ton of skilled trades right now. It's happening with like contractors or anyone else. But in tax, for every five CPAs retiring right now, there's only one new coming into the industry. So there's a shortage to start with. And then those of us who are really specialized and really good at what we do, there's sort of this demand issue. So you're going to pay a premium for someone who's really good and is going to save you top notch. And you may or may not need that. Like it is fine if you don't want to pay that, but there's a trade off. There's always that trade off. So they're absolutely just different services and kind of find what works for you. And you might grow into, like you said, at first your accountant worked. And then when you got into more complex stuff, that didn't really fly anymore. And that's what happens, I think, with a lot of people is you sort of outgrow their comfort zone and you need someone more familiar with what you're doing now.
So when you're looking at people who are coming to you, maybe they had a less than perfect experience with their prior CPA. What are some of the things that you're doing right off the bat to kind of evaluate, what they've done in the past and get them set up for moving into the future more efficiently and effectively?
Yeah, that's a really good question. I tend to amend or correct or could about 40% of potential new clients that come on board. Literally, the phone call I had right before this. So they had a bunch of errors. But so, what I typically do, or what I would tell people to look at if you're not sure if your accountant's not doing it right, like the first things we look at, the big thing is looking at that depreciation schedule. I find crazy amounts of mistakes there. Everything from, like we said, you can't depreciate land. So if the amount listed being depreciated, if you know that's literally what you paid for the property, there's a good chance you're over depreciating it. And so now that's incorrect and you've been taking too much of a write off. The flip side to that is what I've seen missed a lot is if someone's doing a bird deal where you pay in your like renovation costs into your closing, so it's on your HUD. Well, they're taking that total for building, purchase, and renovations and splitting out a portion, a percentage for land. Well, 50 grand of that was just for renovations. No part of that was land. So you're missing out on big write offs. So looking over your depreciation schedule with your accountant, if you pick any form to sort of like scrutinize with them and want explained, look at that schedule. Um, so that's one of the big things I look at. And then just look for, as kind of a starting point, looking for commonly missed things. I see this constantly. I'll get returns where there's not real estate taxes or insurance on it. Maybe someone's not paying their taxes and have uninsured properties, but typically they do. So it's just sort of looking for those specifics that should be there. And then there's kind of examples of things that are wrong that the taxpayer doesn't always know is wrong. The call I had right before this, she had 5 rentals. And in her Stessa, which she used to track it, she had just an account called management. It was just like where her meals and entertainment costs went, office supplies, sort of your general costs that relate to all the properties. And the accountant took that and reported it on a Schedule C, like a separate business, which it's not. But what that did was take 7 grand a year of something that wouldn't have been deductible because it was rental related and her income was too high and made it deductible illegally, basically. And the irony is, she had short term rentals that weren't being treated with that loophole. So, had they just known how to do it right, she would have had more write off than the illegal thing they did. So like they could have had a better tax position and it be correct. So now we've got to go back and change a couple of years worth of stuff. But that's kind of the biggest stuff we look at is just all of it. So that's where I start with everyone is a full review of the prior to year's tax returns and the depreciation. If I know there was like a 1031 exchange done or a cash out refinance, those are almost always recorded incorrectly. And so it's kind of just trying to true up and figure out where things should be and seeing what was missed and what we can get people refunds on. You can go back 3 years for a refund. So check on things before it gets too late.
I love it. There's one thing I wanted to ask you about, and we kind of talked about this a little bit offline. You've got parents, they've got kids. People want to do some advanced tax planning for their kids' benefit in the future. Paying kids and funding Roths, funding retirement accounts. Walk us through how small business owners, with maybe, for example, short-term rental, whatever, can fund their children's retirement accounts legally using taxable income.
Yeah, that's what I was saying is I love this strategy because people are upset about it in both ways. Like anytime I see a video about it, the video is often kind of wrong. People tend to make this seem easier than it is. And then there's also people upset being like, this is definitely tax fraud, but like it's not, it's allowed. There's just sort of rules. So like it's like everyone's upset for different reasons. So what you're allowed to do, and this is 100% legal, I promise this isn't like TikTok advice, is you, as a parent, you are allowed to employ your children who are under 18 to work for you. And they can make, because of the way the tax code is set up, they can make up to the standard deduction and not have a tax obligation each year. So that's just shy of $13,000. So what that means is you can pay them up to that amount before they would have to file and pay any kind of tax. So what it's doing is taking $13,000 from your business income, which would be taxed at your ordinary tax rate, and making it tax-free. The nuances. On top of that, you can fund a Roth IRA. Because again, then it's not going to them. It is in the after-tax bucket. So you can move $13,000 to your kids, make it tax-free, and another $6,000 that you put into a Roth IRA for them. And I just did the math on this, and on average, if you start fully funding a Roth when they're about 10, by the time they're right around 18, they can have close to 6 figures in their retirement account. So at a point where most 18 to 24-year-olds have less than $5,000 in a retirement account, I think is where it's at, 5, 6, right around there, they're going to have between 50 and 100,000, depending on when you start, how the market returns. So that's huge. It's huge for a number of reasons. The nuances that people miss are that you have to pay them a reasonable rate for whatever they're doing. So like, we can't pay your toddler $50 an hour to drool on things. Like they have to actually be doing work, and it would be what you would pay someone else for. This is a part a lot of people miss, is that you actually have to be paying them. They have to be able to do the work. And you still have to file quarterly payroll returns. So like, don't miss that. Like there's kind of these just compliance pieces to put in play, but there's still no tax due, but you still have to just file the return of 0 reportable tax owed. But yeah, the biggest thing is making sure that the children are actually doing what you're paying them for and that it's appropriate. You'll hear people say, oh, well, I'm just going to pay my infant that 13,000 plus 6,000 to be a model, and I'm going to share him on Instagram twice. He's the cutest baby I've ever seen. But the problem is, you can hire a baby, like that sounds terrible, but like there's marketing babies, there's famous babies, like you can get model babies. And so I doubt that that baby's rate is $20,000 for one Instagram post. So it has to be the same thing you would pay a professional model baby. So, but paying your kids is an awesome strategy. It is totally legal. It is a great way to shift income from your business to literally tax-free, and also give your kids a huge jumpstart on funding a Roth IRA for them, which then you're allowed to pull out of that for like a first-time home buying or for certain education expenses. So it's an awesome strategy all the way around, and everyone should be doing it, and just make sure you're doing it correctly.
Well, let's touch on that a little bit further, because you had mentioned, and I don't think a lot of people know this, pulling out of your Roth, if you have a need to do so. What are some of those reasons that you can pull out of your Roth and not have any consequences fall upon you?
Yeah, you're allowed to take your contributions back. So the money you put in, essentially, you're not taxed on that. That is not your earnings. So you can pull that back out. But then additionally, you can pull out without penalty. I believe it's for a first-time home purchase up to $10,000 and a certain amount for education expenses. I know there were some things that just changed around a little bit, some of the rules with this in 529s with this like tax act that passed this past week. So I'm not 100% on where the current nuances are, but basically if it has to do with education or buying your first primary house, it's worth just double checking those rules because they kind of change around and seeing if you can take money out of there without a penalty.
That's that's really cool. I mean, I think you have done a great job of explaining it and the nuance of it and the importance of making sure that when you're doing these things, you're talking with somebody in advance about making sure that you're doing it correctly, you know? So you did mention like how when people are doing the BRRRR strategy and they're doing cash out refinances, that's typically wrong on the taxes, not that specifically, but like, you know, majority of our listeners are going to be buy and hold or doing short-term rentals. So they're going to be buying a place, they're going to be, painting, doing flooring, changing out lighting, maybe some new appliances, those type of standard things, so they're going to be hiring a painter, hiring a flooring person, buying, that standard stuff. Now, instead of just doing the depreciation on those new items, are they able to write off those expenses um, to get their units tenant ready?
So the way it works is there's kind of two timelines. Any cost to get a property ready to be a rental gets added into the basis of the rental. So if you, and this is anything, so keep this in mind, this gets missed a lot, is like if you say you're looking at a new rental market out of state, right? So like let's say you fly to Iowa 3 times the past year, you pay to put in offers on a handful of properties, maybe you put in 2 offers, you paid for inspections, all of these costs, and you don't end up buying. Your third trip to Iowa, you find your dream cornfield house and you were like, well, you're locking this down. All of those costs that took you up to that point from those first few failed purchases get rolled into that cost of what you actually bought. Additionally, you buy it and it needs some fixing up before you can rent it. You're going to put in some new flooring, some paint, just spruce it up first. All of those costs get rolled into the original starting basis. The way the IRS looks at it is any costs before it's in service, which is ready and available for rent. It's like startup cost for a business, like your doors aren't open yet. So they're part of the cost of creating it. Now, they still might be able to be written off through bonus depreciation or just on a shorter life, like flooring is shorter life, appliances. So still separate it out, tell your accountant, but just know as a starting point, it gets added to sort of your starting costs. Once a property is in service, which is like when it's ready and available for rent, or if you bought it with a tenant. This is part of why buying a house with a tenant is great, because if you buy it occupied and then, you issue them notice to move out and they're out in 30 days and then you do a big rehab on it, you've got a lot more flexibility because it's in service that whole time. It doesn't come out of service for a renovation because it was starting being a rental. But if you start with empty house, it's not there yet. But once it is in service, any of your smaller renovations, anything under $2,500, there's a de minimis safe harbor where the IRS basically says we don't care. Not that but like it's not big enough to worry about. So just go ahead and write it off. So if you put in, any of these smaller components, you bought a bunch of paint or you put in, new hot water heater, whatever it was, and it was under $2,500, we can potentially just write it off. Now, we don't always want to do that. Lenders add back depreciation. So any write-off through your depreciation schedule, most lenders will add back so it doesn't hurt you creating a loss. Expenses, they don't. So sometimes you want to look at that too, because it may be more than one way to write it off, and one way might be better for lending. But that $2,500 safe harbor applies to specific repairs. What you can't do is break an entire renovation. Like if you take this house to the studs, you can't break a $50,000 rehab into $2,500 items. Like this was a full, that doesn't work. But still give your accountant the detail, because basically the more detail they have, the more they should be able to write off for you in theory. A great example I like to do is if you have a $10,000 electrical expense, if I just have a line item that says 10 grand electric, I might think you rewired the house. That we need to depreciate across 25 years or 27 and a half years. If you come back and tell me, oh no, Natalie, that was a new breaker panel and we put in some outside lighting and we did, if it was like 10 unrelated small projects, well, now that 10 grand is fully deductible. So what was done is really important. Keep track of costs on a per project basis for materials and labor for each project. Make sure your accountant has that breakout.
hit it out of the park. I mean, guys, this is some fantastic advice and knowledge that you are providing all of the listeners. I mean, this stuff is, and especially now in the beginning of the year when this is going to come out, so you can prepare yourself for this year moving forward to make sure you're doing a lot of these things in advance. And a lot of them, like you said, is just making sure that you're being a little bit more detailed and intentional with a lot of this stuff. I mean, in the past, there's a lot of people out there like, oh, I would love to buy a property with no tenants in it so I can just hit the ground running. Well, you're losing out on a lot of different things. But if you're not having these conversations with professionals like yourself, you're doing yourself a disservice. Like the amount of value that you've already provided in this 45-minute conversation is going to save our listeners tens of thousands of dollars. Like, I'm telling you, it's saved me a ton of money, already. And these things that I've been thinking about, I'm like, oh yeah, I remember having that conversation. I need to make sure I'm doing that for this year. Like all that stuff is really fantastic. I did want to touch base real quick on the short-term rental period, just to go back real quick and say, does any of that stuff apply if you're doing arbitrage? I know if you're buying the property, but for those short-term expenses, like if you're just renting less than 7 days, you're doing it's not passive,
Mhm.
you're doing some active stuff, but it's for arbitrage. Do is that still able to be written off?
So, I would say potentially. It's kind of a unique situation, and people are still unsure fully how to report it. I still report it like a rental activity, but you just don't have depreciation expense because you don't own it. So, the way we would create those large losses doesn't exist typically. I don't think I've ever had someone with an arbitrage that had losses who wasn't just like made a bad deal. So, I don't think it applies in really the same way.
I got you. I got you. Well, I think all of this stuff is really, really fantastic, for putting the plan in place for people with their rental properties. We've touched base on a real estate professional. We've touched base on um, long-term rentals, mid-term rentals, short-term rentals. I mean, all of this really, really great stuff that whether you're a beginner investor or someone that's been doing it for a couple of years can learn from. And, with all, and you even invest yourself. I mean, this is all fantastic, but like, I really want to ask, like, what really, motivates you or motivated you to want to learn, all about these real estate taxes and deal with us crazy, investors?
And it's funny because other tax professionals, I know so many people who hate dealing with real estate people, and it's because they don't understand what you're doing. So, like, when their clients come to them and they say, oh, I'm buying a house subject to, so here's my mortgage documents, it's not in my name. They're like, this is a scam. You got scammed. Like, they just don't get it. So, for me, like I said, it was kind of a natural overlap. I just loved real estate and I was really passionate about real estate. And I knew that that was sort of my answer to retiring early into fire. And when I was working for CPA firms, it would make me crazy when other accountants didn't get it really. So when someone would come in and they'd like cashed out their 401k, like they went all in on going into real estate. And then if your accountant's doing kind of a half-assed job about it and they don't know all of these things to benefit you too, I feel like it's so disrespectful. It's just like undermining what you were just willing to risk if they're creating more risk for you instead of helping get you to that goal. So for me, that was kind of the driving passion point, was seeing this disconnect in the industry and my passion for real estate and knowing there needed to be some good, clear information out there and more people who really understood and aligned with the same vision.
Love it.
Love
So
it.
tell us a little bit about what your goals are. You've started your own practice 2017. You've been working on it for 6 years now. Where are you going to be taking this accounting practice, and how are you building it?
Yeah, so I keep scaling back actually, which sounds weird, which sounds weird, but it's true. It was never my goal to have the kind of company. A lot of I had worked for a CPA firm where we once bought another firm because the person who owned it literally had a heart attack at their desk. And that's what I think of when I think of standard accounting, is like those crazy hours working yourself into the ground. So for me, that was never it. I never wanted to be just like high volume, working 100-hour weeks all year long. Like, I wanted to offer this value of knowledge and advising and save people tons of money at a high value level instead of just cranking out 1,000 super easy tax returns, which, like, to me, most people can now do that themselves on TurboTax. To me, that's not offering anything to people. So I honestly scaling back, because for me, I'd rather work with fewer people at a more in-depth level and know that, like, I know your situation inside and out. And as you were saying, like, when your situation starts getting more complex, you're doing more creative things, it takes more time. And that's really where you have that kind of alignment with your accountant, where there's sort of this level of cohesion where if I know exactly what you're doing and kind of a 5-year plan, we're working together the whole way. So the tax and business plan and portfolio planning is all part of it. So for me, that's what it is, working with kind of fewer people directly or a limited number so that they have that high volume. And then on top of that, I do more on the education side. So same thing, trying to launch a podcast in the next couple months, but then I also do a lot of education for other accountants. So like I teach classes about real estate tax for people to have their license. Like you have to have so many continuing ed classes a year, things like that. Cause I love sharing this knowledge. Like this is the side for me. So it'll be limited firm size. I'm not trying to, have to manage 50 employees. And then as much of this as I can do, teaching, writing, educating, courses, all of that good stuff.
I love that. When I look at a lot of business owners, they normally take one of two paths, either the volume path, cranking out a whole bunch of cheap returns, or the quality path. And it sounds like you're excited to get to a point where you can actually, fire a lot of your clients and focus on the quality ones, because they're going to be paying you more and they're going to want to pay you more because you're going to be saving them more because they're going to be doing more. So I think that's a very incredible way to grow a business. And I very much align with that. And I think a lot of real estate investors align with that as well, as far as
Yeah.
like firing that really crappy rental they have and upgrading it through the 1031 into something that's bigger, and consolidating and paying more attention to it. Like it's a good way to do business. So I really
Yeah.
resonate with that.
And that's exactly it. I think they realize that, like, I'm also an investor. So, like, anyone on this path isn't trying to make themselves more of a job, basically. So, when someone, like, I just had a potential client who does drop shipping and is doing really well with it. And they were like, it's so easy. Let me show you how to do it. I made 7 figures last year. And I was like, if you showed me how to do that, I wouldn't be here to do your taxes. So, like, it's a careful balance of wanting to do this still and loving what I do and reaching that fire point. So,
Yeah, and I really think, um, it's been said over and over and over again, but your team, the
mhm.
people that are a part of your team when it's, going for financial independence, financial freedom, which we're all doing, that happens to be, focused around real estate and the services around real estate, your tax professional, your tax strategist needs to be a part of your team, and they can do exactly like you're talking about with your business, which is, niching down, less clients, higher value. That's exactly what we want inside of our business. Better rentals, better tenants, more cash flow. It all goes around the same thing. We're all talking about the same thing in our own personal, unique kind of ways. And I just love how as you dive deeper into these conversations, you find out that, we're all really working towards the same thing, which is finding value in the passions and the things that we love to do, with people that appreciate that value, that see it, and that
Yeah.
also want to grow as well. So, I mean, I think this is freaking fantastic. I love everything that you've done. And I think this is kind of a perfect segue into the last segment of the show. We're going to kind of switch it up just a little bit. But James and I like to call this one the Big
Big four.
Four. James, take it away.
All right, Natalie. So first question, what is something that you do, business, personal life, that kind of feels like a financial independence cheat code, something like a hack that really propels you to financial freedom?
Yeah, I don't know if I would say that this is necessarily a cheat code for it, but kind of. I think a lot of people get stuck on reducing expenses and kind of trying to save money to maximize, I mean, their savings, obviously. But for me, I automate as much as I can. I think anything that can basically, if you have a skill where your time generates money, that anything you can automate, like at the beginning of each year, I basically, any of my supplies for the house, for personal stuff, all of that, I have on just like a memorized transaction. So that's kind of my cheat code. Is just the less time you spend trying to like, oh, I'm finding a deal on this, I'm finding a deal on that. I will pay full price if it only takes 3 minutes of my life versus 3 hours all day long. And I think once people grasp that, it becomes much easier to value your time and increase your savings and your earning rate.
I love that. I never get over the people who spend like 2 hours for the $5 refund. I'm like,
It's an
like
hourly employee. That's why they think of it that way.
for example, like, I've been caught in this trap too. I've been to Kohl's returning something to Amazon, and the line is like 40 people long. And I've got suckered into standing in that line to return that $15 thing. And I'm like, it's not worth it. Just keep it, donate it, do something.
Yep.
Like go make some money in your profession. If you're worth more than like $15 an hour.
Yep, absolutely.
Exactly. What a great answer. That's the first one we've gotten on that one. And I think top five for sure. All right, this next one we like to call resources. So, besides yourself, are there any particular books, podcasts, or people that have shaped not only your financial independence journey, but that you would recommend our listeners go check out, for all of these amazing, tax tips and tricks that you've been able to provide?
Yeah, kind of the few people that pop to my head right offhand. Love Mindy Jensen, the Bigger Pockets Money podcast. Super big fan. Um, Financial Feminist, I'm a fan of her. Not for everyone, but especially ladies, I think like it. It's a no nonsense kind of way to look at things. And then on the real estate side, Yona Weiss, anyone not following Yona, he's a cost segregation expert, but he is also like a marketing, not even marketing, like connections person. Like, especially on LinkedIn, he will do these follows and these events that just cause so much synergy between people. And I've never seen anyone else function that way. Big fan, follow Yona and get your cost seg advice there. And Russell Brazell, who's an agent in the DC market actually. And he has so much good information that I think is just like he actually saved me on my last home purchase when my agent screwed up. Like he is who had the solution, but he has a ton of great social content. So following those people, that would be kind of top of my list. And Alex Felice, if you want some controversy in your life and want to be like riled up and made fun of till you're good at things, like follow him too for that. It's motivating in a weird way.
I love it, man. Those are all great ones. I mean, you knocked it out of the park with there. Any particular books or podcasts that you're listening to? Doesn't have to be finance related or anything that, let's get into the mind of you a little bit. Like
Yeah.
anything that kind of like, bam, hits right off the top.
Right now published, which is about launching your first self-published book. I'm also reading Launch, which is Jeff, I forget his last name, but it's about launching a product, an offer, and the 30-day stay, which is Sarah, I forget her last name, Sarah Weaver's book on midterm rentals. So that's what I've got on my kind of docket right now. And then podcast wise, right now, because I'm trying to launch a podcast, I'm listening to anything I can find on kind of social media marketing, podcasting ideas, and there's a few there. The one I was listening to right now was I forget her first name, but it's the Something Profit podcast with Profitt is her last name. So
It's awesome.
Providing a ton of knowledge. Thank you so much.
And for those listeners who couldn't see it, she was literally holding up all the books in front of her. So she's got them right. She's actually reading these books. She didn't read them like 4 years ago and is just reading them off memory. Like she's actually reading this. So that's great. For this one, it's a future you, Natalie. I want you to paint a picture for us of you 5 years in the future, either personally, business wise. Where are you at?
yeah, 5 years in the future, business wise, probably firm, similar level, working with like my very best favorite clients, helping them save thousands and thousands of dollars, teaching other tax professionals how to do the same thing because I can only fix so many real estate tax returns a year, so other people have to step it up. So, teaching and the education side, teaching investors how to save all this money. So, really being a person that people think of when they think of who they should look to learn the answer about something related to their real estate taxes. and then probably snowbirding my time between somewhere in the Northeast and somewhere warm for the winter, and working fully remotely, because being like having that freedom was huge for me. That was such a big part of financial independence, and being a virtual firm was getting to work from where you want to be. So I think we're going to see so much more of that going forward with people digital nomading essentially.
I like it.
Exactly.
For those listening and picking up the cues here, Natalie said earlier, there's a need for accountants. If you're looking for a career change, you can work virtually, work on your real estate business, work anywhere, and make some good money too, building a good business. So,
Yep, absolutely.
Exactly. So, for the people that maybe want to utilize your services, maybe want to follow you, learn more, and subscribe to that podcast or YouTube channel when all that comes out, where is the best way for our listeners to get in touch with you?
Yeah, so the best main place to find me, my website is kolotax.com, KOLOTAX. I'm RE Tax Strategist with underscores on Instagram. I'm RE Tax Strategist on Twitter. I just got that. I don't know how to use it. Please follow me and help. Real Estate Tax Strategist on YouTube. And hopefully, maybe by the time this comes out, I'll have the podcast launched, but in the next month. So check back. Please check back, so I'll have more than 4 listeners when I start.
You definitely will. What's the name of the podcast?
I don't know for sure yet, but the working title is the Real Estate Tax Strategy Show. So any combination of that. If you Google Real Estate Tax Strategist, hopefully I am what you find.
I think
Excellent.
What would be a good hit for a name is pay as little in taxes as possible, and you'll have everybody tune in on that.
Pretty much. That's true. That's a good, just from you can't not click that.
Exactly. Well, speaking of clicking things, if you haven't left us a review on Apple, Google, Spotify, if you haven't hit that like button on YouTube that you're watching right now, drop a comment, leave us a review. That's what James and I are working for. We're just working for these reviews. So go leave us a review, share this, like it, all that good stuff. And we'll catch you next time. See you guys.
See you guys.
Thank you for listening to the Real FI podcast, where you learn from the investors that have lived the hard lessons for you. To connect with us during your pursuit of financial independence, be sure to join our community by following us on Instagram or emailing us at info@therealfi.com. If this content made you financially, mentally, physically, or spiritually richer, please make sure to leave us a positive review on your preferred content platform. Cheers to kicking the 9 to 5.